I think the first point to make is, despite kind of all the uncertainties that markets faced at the start of last year, 2017 was actually quite a calm year in terms of what didn't happen. What was remarkable last year was that markets ended up the year with another strong return of 23% as measured by the MSCI World. And also, if you looked at the S&P 500, it actually finished the year with 14 consecutive months of positive returns. And that's despite, as I mentioned, all the uncertainties around Brexit, around Donald Trump's presidency, and all the elections in the European countries. Another good point to make last year, which we found fascinating, were the low levels of volatility that we observed in markets. And that's despite kind of very high valuation levels that we've been seeing. Looking at history, when there's too much complacency or lack of fear in the market, for us, that's generally a time to be a bit more careful. We're now 9 years into a bull market, so just keeping that in mind, market valuations are generally quite stretched across the board. But fortunately for bottom-up stock pickers like ourselves at PSG Asset Management, what is really interesting at the moment is that valuations in most parts of the market are very expensive, but we're also seeing pockets in the market where valuations are extremely cheap. So we're seeing a pretty big divergence across the market, and that still creates opportunities. But generally speaking, opportunities are certainly fewer than there have been in the past. We're generally seeing opportunities in the areas where there's more risk or a lack of visibility in terms of earnings, lack of certainty of future outcomes. Those areas where people are very comfortable with the future tend to be very, very pricey. So going to opportunities, it's really in parts of the market that are less crowded, where people are more fearful. And those tend to be in companies in the likes of the United Kingdom, where Brexit-related fears have kind of driven valuations down. It's also in areas where multi-year weak markets such as agricultural commodities have depressed prices. It happens to be in select industrial cyclical companies, some of those companies that are still exposed to energy end markets that still haven't really recovered. In terms of risks, a lot of people often, in our view, mistake kind of bad companies with risks and great companies as being safe. But I think the big risk at the moment to investors is actually the high quality companies, those companies that people tend to love and know very well. We think bad investments can be made if valuations are simply too high, and we think that's the case at the moment in many parts. I think a good case in point would be in the US retail space. If you look back at the middle of last year, there was a strong narrative in the market that the likes of Amazon or other e-commerce players were going to basically destroy the traditional retail model. And while a lot of that will be true going forward, there is a lot of pressure in that market. When everyone in the market kind of has the same narrative and treats every stock the same, opportunities tend to arise. And in that instance, we were aggressive buyers of a company called L Brands, which we started buying in July until September, where we really think the market's been kind of misunderstanding that business, in that L Brands being a vertically integrated retailer, owning its own brands, its own kind of distribution channels, is well placed in an Amazon world. That's one example where kind of fear has driven share prices to very low levels. Another one being last year would be the likes of Babcock International, where many of their outsourcing peers across the spectrum have been under significant pressure, whether it's from accounting or from contract losses. Babcock, which has long-term contracts in pretty much all of its divisions, for example, in its marine division, their average contract length is over 10 years, has also been driven down to very low multiples. In fact, in recent months, it's been trading at a P ratio of sub 8 times, where we think it's a high-quality franchise, but being treated and with a lot of other companies that are being kind of perceived in a negative light in tougher conditions. Given high market valuations, the fund is now more conservatively positioned. We've had 35% of the fund in cash at the end of December. But that all said, we've still got high conviction in our top holdings in the fund, such as Brookfield Asset Management, which has been a long-term holding, AIA Group, which we've owned for about a year, and then also Babcock International, where Brexit-related fears have driven the valuation to attractive levels. As I mentioned, cash is currently 35%, which is purely driven by a bottom-up process. If you look at the fund, for example, 2 years ago, when the commodity crisis and emerging market crisis drove many stocks to pretty much crisis lows, the fund went on a shopping spree, actually. We had about 8% of the fund in cash at that point, which has served investors well. Also, if you look at our positioning right now, whereas 2 years ago, we had about 50% of the fund invested in the United States, given the revaluation in that market, and specifically our US banks holdings and our holdings in companies such as Cisco or Berkshire Hathaway, Markel, JP Morgan, we've reallocated a lot of capital out of the US into other attractive opportunities. So if you look at our positioning right now on a geographical basis, we've got 22% of the fund in the US, and in fact only 2 companies on the top 10 are based in the US, which actually derive most of the earnings from outside the US. Also, we've increased our allocation to the UK, where we've currently got 15% of the fund invested in that jurisdiction, and then also across the world in attractive companies in areas such as Hong Kong, in Indonesia, and in Japan. Even though a lot of people are very positive on what's happening right now in terms of unemployment and tax cuts, we think people are generally quite exuberant on the market, and we think that our disciplined approach to investing, sticking to our 3M process, will serve investors well going forward.